Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
That U.S. jobless rate climbing to a two-year high in February last month, even as hiring remained healthy, pointing, though, Tim, to a cooler yet resilient labor market. That is kind of our world where we get kind of mixed data points or even mixed facets in one data report.
Okay, well, speaking of the data, it's worth pointing out, even if you've been paying attention to it all day, the numbers once more. Non-farm payrolls advanced 275,000 last month. It followed a combined 167,000 downward revision to the two prior months. Remember, economists surveyed by Bloomberg for this month were expecting 200,000 jobs to be added. The unemployment rate, Carol, did rise to 3.9%. Wage gains also slowed.
Right. So some of those wage pressures may be easing. Hey, listen, let's get more on what our next guest is seeing. Amy Glaser is back with us. She's Senior Vice President over at Adecco, and she joins us from Florida. Hey, Amy, good to have you back with us. We got the monthly statistics. We talked to a lot of individuals. What are you seeing specifically on your end?
Another resilient report. It shows that folks are still hiring and there's still opportunity for job seekers out there. So I think, no surprises in February and probably looking at the same trend over the next couple of months.
Talk more about that.
Yeah, and wage. I'm curious about, because we saw wage gains slowing. Are you seeing also signs of that?
We are. This is something I think we've been talking about over the last couple of months, but it's finally starting to translate. We're seeing not only just wages start to cool a little bit, but also no more sign-on bonuses, huge retention bonuses, all those extra perks. Instead, employers are putting those perks in terms of flexibility. And that's really what we're seeing is driving this labor market right now from an employee perspective. They want flexibility. They want time off. They want a work-life balance. They want to be able to select their own schedules. So employers are able to offer that flexibility and keep wages more in line.
Is that something you see being a permanent shift in the labor market? I mean, I hate to use the word permanent because this is something that's certainly ever changing. But is this kind of a sea change in the way that employees and employers think about their relationship with one another?
Absolutely, I do. And in fact, by 2027, they're saying that the gig workforce is going to outpace the full-time workforce. So
outpace meaning the total number of gig workers will be more than the total number of full-time workers?
Of full-time workers. Absolutely.
Wow. Hey, I want to talk a little bit about labor hoarding. Kathy Wood just talked about this with us. She said that her prediction for this year is that we're going to see less labor hoarding as the economy softens in the coming months. This concept of labor hoarding is one that I think is we're talking about post-pandemic kind of for the first time. Do you see that letting up at all? Is that something you see?
I would agree with Kathy. I think that will start to let up. We were talking about the Great Resignation for the last 2 years, and now we're on the Great Stay. So employees are choosing to remain at their job for stability.
Wow.
I want to go back to what you said about gig workers outpacing regular workers, because I think about the implications for that in terms of benefits, retirement. We had a guest this week that we were talking about how most Americans are not ready for retirement, not even close, and what's going to be the costs of that. But I do think about what are the implications of more gig workers versus full-time workers.
It's definitely interesting to think about, Carol. And, for the first time in U.S. history, we have 5 different generations in the workforce. So I think about my 19-year-old son who doesn't want a 40-hour work week. He doesn't want, that steady income. He just wants the money when he wants it. And we're seeing that in some of the generational trends. So I think it's going to continue to evolve over the course of the next dozen years. We're in this peak 65 phenomenon right now where over 12,000 Americans are turning 65 every single day, which is also creating opportunity as they retire. More jobs are opening up. So I think we're going to continue to see a lot of fluidity within this market.
But Amy, what are you hearing from your clients that give you the indication that we'll have more gig workers? Are they saying, listen, we're tired of paying all the overhead of a full-time worker? Is that some of what's going on?
That's not what's driving it. What's really, truly driving it is the need for a stable workforce in terms of people showing up on time, productivity outpacing today. And they're really seeing that that's what the employee wants. They want that part-time schedule, and they need to be able to plan their work accordingly. So as technology continues to advance, it's enabling employers to reach workers that they haven't reached before and basically plan for any attendance or attrition anomalies.
Okay, so let's talk big picture about technology and the way that you think it will implicate employees in being able to actually not have to do what they were doing before. We had a big story this week that we talked about on the Bloomberg terminal, all about the demographic shift in the U.S. And you mentioned 12,000 people turning 65 each day right now. A lot of those people are leaving the workforce. We're not having kids at the same rate, younger generations these days, as older generations were. We're not creating this path for newly arrived people to the country to become citizens or to work. And it's creating this sort of delta where employers can't necessarily get the workers that they're looking for. I mean, there's still more than 8 million jobs out there that are not filled right now.
Right.
Do you see this getting better because of technology? Or is there a fundamental thing that we have to do in our society to make it so it's an easier pathway for people to start working in this country?
I think it's an interesting question. And I do believe, there's some sense of concern and fear about AI and technology and how it's going to impact the workforce. But I think that's also going to provide opportunity to ease some of the fear out there as we look to make up for those 12,000 a day 65ers that are going to be looking to retire. Time will only tell, but I see positivity in it.
Sounds like you see the glass half full. Correct me if I'm wrong. But we like to talk to you because in addition to the government statistics, we get some insight in terms of what is going on in terms of today's workforce and the workforce to come. I think about the Bloomberg audience. We just talked to Kathy. We wanted to understand, Kathy Wood, the macro environment, because that certainly plays into maybe what companies are doing and companies that publicly held companies are doing, and maybe gives us an indication about the outlook. So having said that, what is the smart narrative for you when it comes to the labor force today, especially when I think about some of the big publicly held companies?
Our clients are feeling a little bit of relief and excitement that the wage pressures have finally started to cool, which should enable them to carry off and have a great financial year. So
you mean like maintain margins?
Absolutely. So I think this is the first time that our clients are feeling that sense of relief. They're also curious about how this gig workforce is gonna be able to impact them. It means they have to change the way they do work. So that's always top of mind to every single customer I'm talking to.
What do you mean by change the way they do work? What do you mean by that?
They're going to have to embrace new technologies that allow them to have scheduling flexibility and be able to accommodate that on-demand workforce.
Do employers want that, or is it not consistent enough?
It's not consistent. The employers that are getting it right and trying to decide how they're best going to accommodate their future are open to it. So I think those are the ones that are really going to excel over the next couple of years.
I think that, Carol, one thing that's interesting about that is, I think from the benefits perspective of that, when you're a gig worker, you don't have the same benefits that a full-time employee has. Not so good for the employee, but for the employer, it offers more flexibility.
Well, and I just think about the cost to individuals, society at large, between healthcare and that overhead of an employee.
This is a country where our benefits, our healthcare is tied to where we work.
Things we're thinking about. All right, Amy Glaser, Senior VP over at Adecco.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
She's the one. She's the one.
Well, as you know, today is International Women's Day, March, Women's History Month. So today, Carol, it's as good a day as any to check in on how American companies are doing when it comes to gender diversity on their boards. Do you, Carol, have any guesses?
No, but I'm assuming if we've got any movement up or down, it's a little bit.
Yeah, hey, you're right.
Thanks. I didn't cheat.
So as of the end of last year, women hold 29.4% of the board seats in companies in the Russell 3000. It's a 1 percentage point increase from the year before. That data courtesy of the 50/50 Women on Boards. It's a nonprofit education and advocacy campaign that's working toward, in its own words, gender balance and diversity on corporate boards.
All right. we've got back with us to talk about this is Heather Spilsbury. She's Chief Operating Officer of 50/50 Women on Boards, joining us from Los Angeles. Heather, good to have you back with us. 50/50, right? That's the mission. So we're not quite there yet.
That's the goal. That's correct. We're not there yet. We're at 29.4, like you said. That's only a 1 percentage point increase from last year. And then our other goal is 20% women of color, and we're still not there yet either. Women of color only hold 7.7% of the board seats.
Help me out here. When I think of ESG, and Tim and I talk about it, ESG, the governance, it's an easy thing to measure the governance, particularly when it comes to corporate boards. Why haven't we moved further along on women representation and people, folks that are Black that are more on, having more representation on the board?
Right. I think a lot of it has to do with the economy, and things that happen within political arenas to take place and take precedence over companies focusing on diversifying their boards. And what we talk about all the time, it's not an ESG or DE&I effort. While it is that, but it's more than that. It's really a business imperative for businesses to be more profitable and productive, and the data all shows that.
Yeah,
the companies with more diverse boards have a bigger market share.
We've been saying that for a long time.
But make that case,
time.
Heather. Bring the data here. Share that data with our audience, because I still think that, we're Bloomberg. We care about the data. That's what moves the needle. So what are the numbers that you have here?
So when you're looking at it from a sector perspective, oddly enough, the financial services sector and the energy sectors are the ones that still have 25% less women on boards. And that's unheard of at this point. It's below the national average. And then when you're looking at states, California and Washington lead with more than 30% women on boards, and Florida, Utah, and Nevada, if you haven't guessed, have the least amount with 25% women on boards. On another spectrum, like in good news, when women are in leadership, boards near gender parity. So if they hold a CEO role, nominating governance, chair role, or chair of the board, the percentage of women on boards is near gender parity, and people of color are nearing 20% of those board seats, with women of color holding anywhere from 14% to 17% of the seats.
All right, so we're going to come over there, and that guy that's talking over you, we're going to just kind of talk him down, man, because this is, it's International Women's Day. We get one day. Just tell him to pipe down over there.
It is.
All right, so Heather, I do think about, listen, I joke, but it's serious. I mean, my whole career, we've been talking about more representation, and the importance of diversification, whether it's people of color, whether it's women, you name it. It's important. It pays off financially for companies. If there was one thing that you think that companies could do to push the needle even further, what would it be?
It's to add one woman to their board. It's really about, sponsorship, sponsoring women, ensuring that you have support there for your women employees and you're moving them up in the ranks into leadership positions. Looking at qualified candidates outside of your immediate network is also a big part of it. People tend to tap people on the shoulder that they know, but you really, you have to look outside of that. So whether you're using a recruiter or whether you're asking your board to also take part in the search, it's really important to go outside of that immediate network and to look for qualified women candidates, which is why we started 50 Women to Watch for boards.
Well, I want to hear, Heather, about when you go to boards or when you speak to people who are the decision makers in these companies, and you tell them, hey, you got to have more diversity on your board. What's the response that they give you? Like, is it like, we'd love to, but what?
I think, and in some cases too, board succession planning is not an easy thing, especially for public companies. So I think part of it is the length of time that it really takes to find the right candidate. So even for large nonprofits, that could take anywhere from 1 to 2 years to find the right candidate to fill the role, to have the expertise, to fit with the culture, et cetera, et cetera. So those are some of the things we hear in terms of board succession planning. There are some companies that just don't want to add women. I will tell you that. I'll just be honest. But the companies that have 2 women on their board have started. They just need to continue doing that by adding additional ones so they can get to that gender parity piece. So for us, it's education. It's educating women on how to pursue that seat, and it's educating companies on why it's so important to have women in those seats.
All right, just tell the guy next to you that it's hard enough, we women. We have to do it in heels. We have to dance backwards, and it's really rough when we have to be heard talk over somebody. Your information was...
Well, luckily we can keep talking without noticing.
You are welcome anytime, because the data that you laid out, so specific, really paints the picture of what's going on and what needs to be done. And you've been watching it for a while now, so we really appreciate it and getting you here. So you are welcome back anytime.
And can I just say one more thing?
Please.
With 50 Women to Watch for Boards, we launched it last year. I know we had a conversation last year. 5 of those women have already secured public company board seats, and we just launched it again today on International Women's Day. So if you're a woman and you're ready for a public company board, please apply. But the goal is to get those women on boards to continue moving the needle and making an impact.
Because they're out there, right? It's
they're
not
out there.
That
They
not
exist.
Out there.
They're on our website if you need a list.
All right, Heather, really appreciate it having you join us here. Have a great weekend. Heather Spilsbury, she's Chief Operating Officer of 50/50 Women on Boards, joining us from Los Angeles. Love it. Love what she had to say, the specificity. I really mean that. Great information, but it really was kind of ironic and funny to be like, here we are.
I did promise, Carol, that I would not Tim-splain anything today.
No Tim-splaining
No
today.
Tim-splaining
I get one
today.
day.
Yeah,
I get
day.
one
That's
day,
it.
which I really appreciate. You actually are pretty good about it.
Pretty good.
Other people, not so much. All right, this is Bloomberg Businessweek.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, we've talked in the past about the largest transfer of money in U.S. history. It's the so-called Great Wealth Transfer, the wealth that's set to be passed from boomers to their children over the next 2 decades. More than $70 trillion. That's according to the financial services firm Cerulli Associates.
That's a lot of money, right? We
Yeah.
talked about this earlier. And you think about the implications, some broad implications for families, the taxes they pay, the charities they donate to, and more. Really a lot of impact.
It's almost like there's an entire industry around this because it's so much money.
There is.
There is, okay. Well, our next guest actually argues that when it comes to this wealth transfer, we need to focus on the implications specifically for women. We've got Tracy Bell with us. She's Director of Equity Strategies at First Horizon Bank, joining us from Birmingham, Alabama this afternoon. Tracy, good to have you with us. How are you?
I'm doing great, Tim. It's nice to be with you.
Nice to have you with us. So there's some really interesting data in the notes that you sent along. It's not just the fact that women tend to live longer than men and why we need to think about the implications of this wealth transfer for women. So there will be women living, more women, single women later in life who need to support themselves. But also you point out that in younger generations, there's a higher number of single women in the millennial generation, my generation. Talk to us a little bit about the demographics here.
Yeah, so you've cited those statistics perfectly. So this is happening in 2 areas. There's the baby boomer wealth transfer from unfortunately deceased spouses to their wives, but then that money will eventually trickle down and will be inherited by the millennial generation. And in that generation, the median age for women to marry in that generation is around 28, which is different from a median age of 22 in 1980. So that means that these ladies are more independent and financially savvy for longer before they enter into relationships. And they're also more educated. So 44% of bachelor's degrees or higher have been earned by this generation, as opposed to 21% in 1980. So they have a very different financial profile than some of the older generation.
Hey, what does it mean for a firm like yourself? And I think about this many moons ago, early in my career. I remember a well-known voice on Wall Street saying, you know, when I'm managing money for a couple, I actually want to make sure that I'm meeting with the wife, because in the long run, I'm going to end up talking with the wife, and I want to make sure that she's comfortable with me and we're on the same page. So I'm curious what that means. Are you bringing in more women financial advisors because that's what women want? Or I don't know. Like, I'm just curious how that affects the dynamics of how you guys kind of run the business that you do.
Well, part of what we do now is be sure that we do focus on making sure the wife in the relationship or the female partner in the relationship is part of the conversation. And this is different by demographics as well. You know, within the baby boom generation, that's a little more of a challenge and you have to make more of an effort. Within the younger generation is already more involved. So that's less of an effort there to make sure that you have both parties involved in the conversation. But it's a well-known fact in the financial industry that after a spouse passes away, there's a really high chance that the female surviving spouse will change their relationship with their financial advisor within 1 year of their spouse passing away. So it's something that the industry has to really pay attention to.
Why does that happen?
I think it's just a lack of communication. There's something that we see with women investors in particular. They want to be listened to, and they want to be listened to in a way that is educational and has the right tone in that communication. And they want advice. So one of the things we notice with women investors is they're not overconfident. They know what they know, but they also know what they don't know. And they really depend on the advice of a professional to fill that gap. They want a good team around them.
Huh, interesting.
Hey, I wanted to shift gears a little bit and talk about new businesses being formed, because we also understand that more than half of new businesses out there are being started by women. What does that mean for women who are inheriting money or for wealth being passed down through generations, and how the money ends up being used?
Yeah, so more than half of new businesses are started by women, and this likely is going to continue. And this wealth transfer will only help that. And not only will it help the numbers, but it will also help the financial stability and the launch of those businesses. So women that are having an increase in wealth will have longer that they can operate these businesses. They will be more well funded when they begin, and it really should only help in their success rate over time. And then women-owned businesses tend to hire more women, promote more women, and pay women better than non-women-owned businesses.
One thing I want to ask you, and I'm curious about implications of the younger generation. We had a voice on earlier from Adecco, so they deal with employment needs, and they talked about growth in the gig economy, and that at some point they anticipate that the gig economy will be responsible for more than half of the jobs that are out there, so overshadowing full-time employment. And I do wonder what that means in terms of, okay, if you're a gig economy worker, you don't get kind of all the benefits, whether it's a 401k or, and the like. And I do wonder, younger generation, maybe those who aren't inheriting wealth, how they are potentially thinking about their retirement needs, women in particular, the younger generation. Do they really care? Are they involved at this point, especially if they're not inheriting it? I just wonder how they're thinking about it.
That's an interesting question. I think as people get older, they consider those things more, and maybe the gig economy is less attractive once people begin to consider those factors. Retirement savings for women is a very big deal, and it's a hurdle. So you have to think about the challenges that women face. Longer lifespans. So this is just a math problem, longer lifespans. So you've got to save more money over time to fund yourself longer in retirement. That wage gap that is very well known. Women tend to earn less over their careers, so there's less money going in. And then women also tend to be more conservative in their investment choices. So making sure that you're investing aggressively enough to earn a higher enough return over time for your retirement savings to grow is also very important. And then there's a last factor. Women tend to have healthcare needs that are greater later in life, and that's expensive as well. So I think as people move through their career, if they've been in the gig economy, they might start thinking more about how they need that retirement, and maybe the gig economy doesn't stand up.
We've talked about demographics in the context of small business, but I'm also curious about where this money ends up going in terms of charity, nonprofits, that sort of thing. What does your research tell you about this money, when it is inherited, where it goes, how it's being spent?
So it's, again, well documented that women tend to give more of their money to charity, a greater percentage of their money to charity. They think about social and well-being outcomes. They think about community. And they also tend to give to charities that support women and girls. So that's an area where we may see a shift towards funding and financing in the nonprofit area, and women greater supporting those areas. As they start new businesses, they may also start new businesses that tend to focus in those areas. So the nonprofit area and charitable giving for women is a very big deal.
Hey, I do wonder as we get ready to wrap up here, Tracy, like what's the number one step for someone who may be listening and they know that, at some point I am going to inherit some wealth going forward, but I haven't been involved in terms of the money management in my partnership, or I don't know, I just haven't been involved in general. What's the first one step that they should take?
One of the things that I say to groups of women when I'm speaking to them is this is something that you cannot outsource. You need to know what's going on in your financial life, whether it's you personally or involved in a relationship. You need to get the information together. You need to understand your numbers. Where are you now with your savings? Where do you need to be in 5, 10, 20, 25 plus years? And then map out a plan for getting there. There are countless financial advisors, financial planners, attorneys, CPAs that you can put together as a great team to work around you to help you figure out where you are today and then map that place going forward. So the first step is getting all your information together and understanding where you are.
All right. Sounds like a smart plan. Hey, Tracy, thank you so much. Really appreciate it. Tracy Bell, Director of Equity Strategies at First Horizon Bank, joining us from Birmingham, Alabama on this International Women's Day.
We've spent so much time this week talking demographics.
We have, really, right? Are you like...
Oh, yeah. And I think it's like the biggest thing that is not being talked about right now.
I agree. And the impact that we're going to feel down the road, no doubt about it.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, just about 18 minutes left in today's trading session, getting ready to wrap up the Friday trade and the week overall. We are seeing, as you just heard from Charlie, pretty much equities near their lows of this session. The NASDAQ 100, the biggest hit of the major equity averages here in the U.S., down about 1.4% here, Tim, as we said, with just about 18 minutes to go.
Hey, you know, Carol, I'm like always thinking about decliners.
Because you have to.
Because I have decliners. And oftentimes it's kind of tough in recent months because the market has been up so much to find good decliners.
A plethora today?
There's like a dozen stocks I want to do to the downside. I mean, you could do like all the chip companies now.
Yeah, which has been
Boeing
a change
is a
in the
story
trade
too
that we've
today.
seen.
Yeah, it is. It is totally a change in the trade.
And
that we've
earlier
seen.
today, NVIDIA, AMD, they were all atop the major equity averages. Yeah, they're down.
Yeah, well, so makes a market. Hey, that's why we want to talk to Kelly Kowalski, portfolio manager at MassMutual, joining us from Boston this afternoon for our drive to the close. Kelly, I want to start with the jobs report because that's what we got earlier today. We've been talking about it throughout the day today. Unemployment rate ticking a little bit higher. We're seeing wage growth move up, but not as quickly. And then we're also seeing more jobs added than economists expected. Your big takeaways about what it means for the economy.
Well, thanks, Tim and Carol, for having me today. I think the jobs report today was a bit of a mixed bag. Although the headline beat, we saw that about 1/3, a little bit more, of January payrolls were just revised away. And if we look at some of the underlying data in the February numbers, about half of the job gains came from education, healthcare, and government, so your more non-cyclical sectors. I do think this still fits it within the market's soft landing narrative, and it is Fed friendly. So we really have to balance looking for that inflation progress with how's the health of the underlying economy.
How easy is it to be a portfolio manager today? In this
it
environment?
Is not easy.
You looking for a new job,
This
Carol?
has nothing to do with being a woman or anything like that. That's not what I'm getting into. But in this environment, how tough is it?
It is tough in this environment, especially because we focus on credit. So as credit investors, we think markets are kind of priced for perfection right here. Mm-hmm. We really look at spreads as a measure of stress or risk in the market, and they are very tight. They wouldn't tell you that there is any sort of risk of downside or recession. So when we're trying to really maximize spread in this type of environment, it's challenging.
You know, it's funny. One of our most read stories on the Bloomberg, credit markets are acting like easy money era never ended. And they talk about the riskiest global debt is outgunning safer fixed income assets. Investor euphoria harking back to the days before central bank rate cuts. Does that sound fair to you, that assessment?
Well, I think that there is a lot of positive sentiment, and certainly within the investment grade market, we saw the busiest February issuance on record. Mm-hmm. I don't think we're seeing the level of aggressive lending that we saw in 2021, for example. But it is a tough market, and I think that again, if you look at sort of high yield where you have more risk, spreads are below their 10th percentile historically. So, there isn't a lot of sort of, downside or negative sentiment really being priced in at all.
Right. Spreads between junk bond yields and investment grade counterparts are tight. So it's interesting. So I think about all of that we got from Jay Powell this week, and like whether he likes it or not, right? It continues though to be an environment where companies of almost all stripes can access funding. Is that safe to say?
That's the current environment right now. And I think that, we've seen financial conditions actually ease over the past several months. So when the Fed is thinking about, hey, do we need to cut? That's one of the things that they're looking about right now and really saying, I don't know if there's that much urgency now. If you look at capital markets are functioning fairly well.
Yeah, right. Which is good. But all right. So for someone who does have to focus on credit, where do you allocate if you've got some new money to put to work?
So over 90% of our long-term bond portfolio is in investment grade bonds. I did mention spreads, which is what we look at, but all-in yields, on a historical basis, aren't that bad if you're locking in, a little over 5%, for example, on, a 7-year duration corporate. We do like staying high quality here, just because we are sort of a little bit, focused on the downside and thinking about the risks. But we think high quality fixed income, and we also, don't think cash is a bad placeholder right here to have some dry powder for opportunities.
How much in cash, and how much is it compared to what you guys usually do? Is it more than you usually do?
Slightly more. I would say that we're certainly not, we wouldn't think of ourselves as completely fully invested here or fully risk on. We continuously have to invest. We have insurance liabilities that we need to invest to back. So we need to sort of pick the best opportunities. But we think this is a time where you want to have a little bit more dry powder to take advantage.
Talk to us more about these insurance liabilities. It's not something we talk a lot about when it comes to our drive to the close.
But we talk a lot about the rising costs of insuring homes in California.
Yeah, one of the most
Florida.
read stories this week on the terminal is a big take all about how there's a tinderbox out in California because so many of the homes out there are uninsurable.
So MassMutual, our focus is we have a great product mix of whole life as well as annuities and some other products. What I actually focus on is an annuity portfolio. And we've seen, because of the high yields in the short end, we've seen incredible demand there for annuities. But at the same time, that's also caused a lot of competition in markets for, shorter assets. But it's actually been complemented because if you look at a lot of, issuers and treasurers of corporates, they don't want to issue at the long end because they don't want to lock in these long rates. So we have found, opportunities, call it, within 7 years and in.
Yeah, and it's just kind of to wrap up, it's interesting too because of what you have to do because of the insurance liabilities. I mean, when you look at the environment, how comfortable do you feel? I started saying, when we kicked off this conversation, what it's like to be a portfolio manager right now, and it's tricky. But I mean, having said that, when you look at it, the outlook, the visibility that you have to have a longer term visibility. How comfortable? Do you feel more comfortable kind of looking out 5 to 7 to 10 years versus maybe looking out at the next 6 months, 12 months, 1 year right now?
Absolutely. We're not, investing based on whether the Fed's going to cut in June or July, because as we've seen, the market's consistently gotten that wrong. And I think most people have gotten it wrong. But yes, we take a long-term view and we're looking at where we are in the default cycle. Defaults are low, but they're starting to tick up. So how does that position us, and kind of goes back to what I said, if we're entering into a default cycle, how should we position ourselves? And really having that long-term view is key to what we do at MassMutual.
All right. Well, great stuff. So appreciate it. Kelly, thanks so much. Have a great weekend. Kelly Kowalski, she is portfolio manager at MassMutual, joining us there from Boston.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.